If you are broke, overwhelmed, or think investing is only for rich people, this video is for you. I wish someone had told me these investing basics when I was starting from zero in my early 20s. In 2026, you do not need a lot of money or fancy knowledge to get started. Today, I will walk you through the simple investing basics every beginner needs, explained like you are my friend who has never done this before. In 2026, the idea that investing is reserved for the wealthy has faded. For many, the first step is as simple as opening an app and setting aside a few dollars, sometimes less than the cost of lunch. Years ago, my own savings barely stretched to cover a week of ramen, but today, platforms like Robinhood, Fidelity, Schwab, and Vanguard have changed the rules. Zero minimum balances are now standard. Fractional shares mean that owning a piece of Apple or the S&P 500 no longer requires hundreds of dollars. On Robinhood, $1 is enough to buy in. Fidelity and Schwab offer the same, and Vanguard's minimum for most funds is just $1. Even IRA accounts, once out of reach for beginners, now open with as little as $50. Robo-advisors like Betterment and Wealthfront allow recurring investments starting at $10 a month. The process is straightforward. Download an app, tap to open an account, and fill in basic details: name, date of birth, social security number. Linking a bank account takes only a few taps, with secure systems like Plaid protecting your information. For added security, two-factor authentication can be enabled, requiring a code from your phone each time you log in. Transferring funds is quick. Whether it is $5, $20, or more, the money usually appears in your account within a day, thanks to T+1 settlement rules. Gone are the days of waiting 2 or 3 business days for transfers to clear. Fees, once a major barrier, have largely disappeared. The major platforms now charge $0 commissions on stocks and exchange-traded funds. Any uninvested cash is typically swept into a money market fund, earning interest while you decide what to buy. Choosing the type of account comes next: taxable brokerage, IRA, or if available, a 401k. For most, a basic brokerage or Roth IRA is the starting point. IRA accounts may require $50 to $100 to open, but regular brokerage accounts accept any amount. The choice is yours based on tax goals and timing. Before purchasing shares, it is wise to keep some cash for emergencies. Investments can grow, but they are not a substitute for an emergency fund. High-interest debt should also take priority, since credit card interest outpaces most investment returns. Keep an emergency buffer before you invest. Getting started does not require a finance degree or a large paycheck. A few dollars and a phone are enough. Skipping a single takeout coffee can fund your first investment. In 2026, investing is accessible to anyone willing to begin. Picture this. You are at the top of a snowy hill with a tiny snowball in your hand. That first $20 I ever scraped together for investing felt just as small, almost laughable. But here is the wild part. With investing, that snowball does not just roll, it grows faster the longer it is moving. That is the magic of compound interest. Every month you add a little more, maybe $25, maybe just the spare change from skipping one fast food run, and each new flake sticks to everything that came before. Over time, the snowball picks up speed. The interest you earn starts earning its own interest. The numbers get bigger, and suddenly, you are not just pushing a snowball, you are steering an avalanche. Let us put some real numbers on it. If you set aside $25 a month, less than most people spend on streaming subscriptions, and put it into a simple, broad market index fund, here is what happens. After 10 years with average market returns, you could have around $5,000. Stick with it for 30 years, that snowball could grow to over $51,000. And that is not some pie in the sky if you win the lottery scenario. That is just the math of regular investing, even if you are starting small. The best part is you do not need to be a financial wizard or check the market every day. You just need to keep rolling that snowball, 1 month at a time. Behavioral studies back this up. People who automate small, regular contributions are much more likely to stick with investing and see results. It is not about timing the market or picking the next big stock. It is about showing up, month after month, and letting time do the heavy lifting. The earlier you start, the more time your money has to grow. Even if you can only manage $5, $10, or $25 a month, you are building momentum. Every snowball starts tiny. What matters is that you give it a push. So if you are sitting there thinking, I am broke, what difference can $25 make? The answer is a huge one if you let it roll. You do not have to be rich to start investing in 2026. You just have to start. Your future self will thank you. Stock picking is often compared to a blindfolded game show. Exciting at first, but rarely a path to lasting wealth. Most professionals, in hindsight, wish they had chosen a simpler route, owning the entire market. Index funds and ETFs offer this approach, letting investors hold shares in hundreds or thousands of companies at once, building instant diversification. Exchange-traded funds trade throughout the day, like stocks, and can be purchased in small amounts, while traditional mutual funds typically require higher minimums and update prices only at the end of the day. By 2026, ETFs have become the preferred entry point for new investors, offering flexibility and accessibility. The real advantage lies in cost. Leading index ETFs, such as Vanguard 5 TI or S&P 500 funds like VOO and IVV, charge as little as 0.03% annually, just 30 cents per $1,000 invested. Over 80% of active managers fail to outperform these simple indexes, despite charging higher fees. A low-cost, diversified ETF quietly outpaces frantic stock picking, making investing accessible to nearly anyone. Checking your investments every day is like weighing yourself after every meal, tempting but not helpful. I will admit it. I used to refresh my app every morning, my heart pounding whenever the line dipped. But here's the truth every beginner needs to hear. Markets go up and down, and those dips are not a sign you have messed up. They are just part of the ride. Imagine a roller coaster, not a straight escalator. The real danger is not the drop itself, but the urge to jump off at the worst possible moment. Here is what trips up most new investors trying to time the market. Studies show that missing just the 10 best days in the market over 30 years can slash your returns by about a third. That is the difference between ending up with $1 million or $700,000. All because you panicked and sold during a dip and then missed the recovery. The old saying is true, it is not about timing the market, it is about time in the market. So what is the smarter move? Treat investing like brushing your teeth, regular, boring, and automatic. Set a rule for yourself. Only check your investments once a quarter or when you do your taxes. And remember, this is not gambling. It is a long game. If you catch yourself wanting to sell everything on a red day, take a breath. The biggest rewards go to those who stay strapped in, even when the ride feels wild. You do not have to be rich to start investing in 2026. You just have to start. Your future self will thank you. Picture your phone reminding you about a $5 recurring buy right before you even have time to overthink it. That is the beauty of automation in 2026. Every major investing app, from Robinhood to Fidelity to Schwab, lets you set up automatic investments for as little as $5. It is not a trick, it is a behavioral hack. You set it once and the app does the rest. No more forgetting, no more talking yourself out of it when the market looks scary. This is called dollar cost averaging. You pick an amount, maybe $5, maybe $25, and the platform will buy your chosen exchange-traded fund, ETF, or index fund on a schedule. Some platforms even let you reinvest dividends automatically, so every penny keeps working for you. Robo-advisors like Betterment and Wealthfront go a step further, rebalancing your mix so you do not have to lift a finger. The whole thing takes less than 5 minutes to set up, and you only need to check in once a quarter, or when you get a tax form. Want to avoid panic selling on a bad news day? Mute those app notifications. Seriously, try it. Your future self will thank you. The real flex is building a habit so automatic you barely notice you are investing. Here's my friendly dare. Set up your first auto invest tonight, even if it is just $5. You do not have to be rich to start investing in 2026, you just have to start. Your future self will thank you. Right now, investing for beginners in 2026 is more accessible than ever. No big bucks, no intimidating jargon, just real steps that work even with a small start. So why wait? You don't have to be rich to start investing in 2026. You just have to start. Your future self will thank you.